Hello, ladies and gentlemen. It is 10:59. We've got about 60 seconds until we start, so hang tight. We're going to relax and let the people who have registered log on, and then we will start in just under 60 seconds. So hang on, and we'll get started soon. All right, ladies and gentlemen, it is 11 a.m., so let's go ahead and get started with today's 1031 Exchange webinar. Thank you all for joining us today as we start to kind of reopen our economy and get back to business. I think it's imperative that if you are a real estate professional, you really understand the concepts regarding 1031 exchange. So we're going to talk a little bit about that today. Today's webinar is our advanced 1031 exchange class. So what we're going to do is we're going to assume that most of you have the basic understanding of the 1031 exchange process. We're going to go over the basics really quickly, but we're going to use today's webinar to dive into kind of the more complex issues. I'm going to be your host today. My name is Leonard Spoto, and I'm one of the owners of Asset Exchange Company. Before we get started, I have a couple housekeeping items to discuss. If you have a question about the material or about a specific 1031 exchange you are working on, please do type your question in to the questions dialog box on your webinar control panel. That will push over the question to me. It'll pop up on my computer screen, and I will try to answer all questions as they come over or as they are appropriate. Now, the second thing everybody usually asks me, or a lot of people ask me, hey, Leonard, is this webinar going to be recorded? And the answer is yes. You are going to get a copy of today's presentation material as well as a link to the recorded version of today's webinar. All of our webinars are recorded and then we post them to our YouTube page. So you can share them with your colleagues, your spouses, or your clients, or you can just ignore our email. So we do post those for you for your future reference if you want. All right, ladies and gentlemen, let's go ahead and get started. Today's 1031 Exchange webinar is Advanced 1031 Exchange, but before we get into that, I do need to talk about one of the most pressing issues that came into the 1031 exchange world with the coronavirus, and that was an extension for 1031 exchange timeframes. So back in April, the IRS granted us some extensions for doing a 1031 exchange. So the typical 45 and day 180 timeframes were pushed back. So you're going to qualify for a 1031 exchange extension if you have a day 45 or a day 180 that falls between April 1st and July 15th. So if either one of your deadlines for your ongoing exchange falls between April 1st and July 15th, you get an automatic extension. Your day 45 will be pushed back to July 15th, or your day 180 will be pushed back to July 15th. So let me give you an example of how that would work. All right, so there's two examples on the slide here. Taxpayer Bob. Taxpayer Bob, he sold his property on March 1st. That was a couple months ago, and that put his day 45 at April 15th. Well, because of this new extension, the government says to Bob, hey, Bob, you don't actually have to identify on April 15th. You get to identify your replacement property on July 15th now. All right, so that's one example. Day 45 is simply pushed back to July 15th. We have another example. Taxpayer Sue, she sold her property way back in October, and that would put her day 180, the end of her exchange, at April 1st. But because it falls within that time frame, Sue does not have to end her exchange on April 1st. She gets to actually get an additional amount of time to complete her exchange. So her day 180 is now pushed back to July 15th. All right. The problem with Sue, though, is she's already identified, and she does not get any extensions for her ID letter. All right. So that's how the government decided to offer extensions to 1031 exchange clients during the COVID-19 shelter-in-place kind of emergency that we've been facing. Now, we have requested additional extensions and additional guidance from the IRS, and we have not heard back. As soon as we do, if they decide to provide clarification on these rules or any additional extensions, we will absolutely let you know. All right, but this is what we have right now. Now, the bummer about these rules is they do not really help out someone who's going to close escrow today, because the July 15th, day 45 is the furthest extension you're going to get. So if you close escrow on June 1st, your day 45 is July 15th anyway. So you're not going to get any relief. So these extensions are kind of a bummer. They're not really helping people out anymore. Yes, they helped people out who closed, a couple months ago, but they're not doing anything for us today. So it is a bummer. We are asking for additional relief, and when we get it, we will let you know. All right. Now, with that said, let's go ahead and jump into the presentation. Okay. Now, what qualifies me to hold these webinars? Well, I've been doing this for about 20 years. I run a 1031 exchange accommodator or qualified intermediary. And as such, we do about 150 transactions per month. Now, we do not sell real estate, though. We don't buy real estate. We don't do escrow or sell title insurance. The only thing that we do is facilitate 1031 exchanges. So a lot of people get done with this webinar and say, hey, Leonard, I don't really understand what you do. Well, we are an accommodator, okay? So what that means is we're going to hold all the sale proceeds from the sale of your property. We're going to prepare all of the legal documents that are required, and we're going to make sure that the client doing the exchange is in compliance with the 1031 exchange rules. Very, very important. When you do a 1031 exchange, you need to work with an accommodator. It's required by law. Now, my company's been doing this since 2006, although I've been in business for about 20 years now. And we are very, very good at what we do, ladies and gentlemen. So part of my reason why we do these webinars, obviously, is to educate you, the real estate professional, but also to convince you that we know our stuff and that we want to work with you. So if you feel we do a good job today at today's webinar, give us a shot on your next 1031 exchange. It will be our pleasure to work with you. All right? So let's talk 1031. Again, today is the advanced 1031 exchange class, so we are not going to go over all the basics, but I do want to highlight some key, important, fundamental information about 1031 before we get into the details. So what is 1031? Well, Section 1031 of the Internal Revenue Code is the greatest wealth building tool available to an investor. It really is. So Section 1031 is just a piece of the tax code that says that when you sell an investment or business use property, you can defer your capital gains tax, provided you go out and you buy another investment or business use property, right? So the key to a successful 1031, number one, you have to understand the exchange rules. That's what we're going to talk about today. Number two, you have to make sure that you're securing replacement property, right? You don't have a successful exchange unless you go out and buy replacement property. So that is extremely important. The earlier and sooner you can start looking for replacement property, the better. And part of that, obviously, is you need to make sure if you're going to do an exchange and you want to do it well, you've got to build a good top-notch team. All right. So those are my keys for a successful 1031 exchange. Now, why are clients doing 1031 exchanges? And this is important. Why would someone consider an exchange? Well, because they don't want to pay taxes, right? Did you know that when you sell real estate, if you cash out of your property, about 1/3 or 33% of your gain goes to pay taxes? Okay, that's a big number. A lot of people think, oh, geez, it's only 15%. Wrong. Okay, between the state and the federal taxes, you've got a tax rate of about 33%. So people do 1031 exchanges because, number one, they don't want to give their money to the government. But that's not the only reason they do exchanges, right? People do exchanges because they are looking to build wealth through real estate. And the best way to build wealth is when you sell a property is not to give 1/3 of the money to the government, but to keep all of that money in your pocket to go out and buy bigger and better real estate. So if you are looking to build wealth in real estate, you need to be an exchanger, because understanding the process and running your transactions through the 1031 exchange process is going to save you hundreds of thousands of dollars. And that is money that will get you into bigger and better property. All right. So clients are doing exchanges because they are building wealth in real estate. Now, some of my clients are already very wealthy. And when you own a lot of real estate, you've got millions of dollars tied up in real estate. One of your main goals is to protect and preserve that wealth. And the way you do that is by diversification. Now, when you own real estate, there's a couple ways to diversify. You can go into different geographies, you can go into different types of real estate, or you can do both. Now, if you use the 1031 exchange, you can sell a property sitting in San Francisco and go out and buy a property in a different geography, right? If you've got $10 million worth of real estate in San Francisco and there's an earthquake, well, you could lose all of your wealth. So diversification through a 1031 exchange to go into a different area that is not prone to earthquakes is a very good idea. All right, so people use the 1031 exchange, yes, to build wealth, but also to protect their wealth. And then people also consider 1031 exchanges because of time. Two things happen over time when you own real estate. Number one, you get sick and tired of it. And number two, your property becomes fully depreciated. And both of those, ladies and gentlemen, are very good reasons to consider an exchange. Imagine if you are 75 years old. You've got an apartment building, and every time there's a leaky faucet or a broken toilet, your tenants give you a call. Well, at the age of 75, you're probably thinking, geez, I'd love to spend less time with my tenants and more time with my grandkids. So you might want to consider a 1031 exchange out of that tough to manage property and into something that it is easier to manage. This, ladies and gentlemen, is the number one reason why my clients are doing exchanges. They're older and they want to spend less time dealing with the terrible T's, the toilets, the tenants, the trash. So they get out of their tough to manage properties and they 1031 exchange into something that is easier to manage. And then finally, sometimes people will do a 1031 exchange simply because their property is fully depreciated. And if you're a real estate professional, you understand the power of depreciation. It allows you to shelter your rental income from taxes. Well, once you've owned a residential income property for 27 and a half years, your depreciation is gone and you pay more taxes. So sometimes your CPA will say, hey, exchange that fully depreciated property into a new larger property where you can get new depreciation schedules. Okay. These, ladies and gentlemen, are the reasons why my clients do their 1031 exchanges. Now, there's some other reasons, right? But these are some of the primary motivating factors that compel investors to do 1031 exchanges. But if we're going to get down to it, it's usually about the tax bill. People hate paying taxes, and once they find out that their tax bill is going to be $50,000 or $150,000, they're very motivated to investigate their 1031 exchange options. Now, again, as I mentioned, the tax rate is about 33%. Okay, but a lot of people think, well, geez, it's only 15, so maybe I'll just cash out and pay my tax. Well, they're missing the entire picture. Yes, your capital gains tax bill starts at 15%, but depending on your income, that rate could immediately bump up to 20%. All right, so your capital gains tax bill will either be 15 or 20%, depending on your income. But the federal government also has what is called a depreciation recapture tax, and that is a tax on the amount of depreciation that you've taken, and that tax rate is 25%. It doesn't stop there. The federal government also instituted a Medicare tax that kicks in, and that tax rate is 3.8%. And that tax rate kicks in on higher income earners, which most of you, when you're selling real estate, will be. So you've got federal taxes to pay, but it doesn't stop there. Ladies and gentlemen, if you are sitting in the beautiful state of California, like I am, you're also going to have California state taxes to pay, which start at about 9.3%, but go as high as 12.3% depending on your income. So when all is said and done, if you decide to sell your real estate and take your money, you are going to pay about 33% of your gain to the government. Now, it's very important to note that I said 33% of your gain. And a lot of people don't understand how gain is calculated. So being the Advanced 1031 Exchange class that I'm hosting today, we're going to spend some time doing a little bit of accounting. And don't worry, it's pretty easy. What we're going to do is we're going to understand how to calculate our gain. So how is gain calculated? It's simple. Take a look at your computer screen. Gain is a function of your net sale price minus your adjusted basis. So very important, I said net sale price. So that is after commission and closing costs. All right. So you've got your sale price. You take out your commission and closing costs. That's your net sale price. And then if you subtract your adjusted basis, you get your gain. Ladies and gentlemen, notice that I do not mention how much debt you have. Your loan or your debt does not factor in to your tax bill. Sometimes people will say, well, geez, Leonard, I sold a property for $1 million and I have $900,000 of debt on the property. So my gain is only $100,000, right? Wrong. Your debt does not factor in to your tax bill at all. The way we figure out our tax liability is we need to know how much gain we have. And gain is a simple function of your net sales price minus your basis. Well, you might be sitting there thinking, well, geez, Leonard, that's great, but what the heck is my basis? Well, your basis is a simple calculation. Your basis is simply your purchase price, how much you paid for your property, minus your depreciation, plus your capital improvements. So let's do a real quick example. If I bought a property for $500,000 and I've taken $100,000 of depreciation, At one point, I had put a new roof in, and that cost me $25,000. That's a capital improvement. And then I go out and I sell my property for a net sales price after commission and closing costs for $1 million. I can figure out what my tax bill is going to be just with this information. All right. So let's do a few quick, simple calculations. First thing that we need to do using this information is figure out my basis. All right. If you pass third grade math, you can probably follow along with me to figure out your adjusted basis. It is, again, your purchase price minus your depreciation plus your capital improvements. So in this example, I'm going to have an adjusted basis of $425,000. Now, if I sell the property for anything above $425,000, I have gain. And in this example, I sold my property for $1 million. So how much gain do I have? So that is correct, $575,000 worth of gain. Now, again, notice I do not mention or need to know how much debt you owe against this property. It is irrelevant. Okay, for tax purposes, we don't care how much debt you have. All we care about is what your sale price is and your basis. So with a $575,000 gain, your CPA is going to crunch the numbers, and using all of those taxes that I mentioned before, your depreciation recapture tax, your 20% federal capital gains tax, your Medicare tax, and your state tax, your CPA is going to tell you that you have a tax liability if you cash out of the property of almost $200,000. Ladies and gentlemen, how many of you are interested in paying the government almost $200,000 when you sell your property? That's right, none of you. Okay? The great thing is you don't have to pay that tax bill. The fantastic thing about real estate is the most tax-advantaged investment out there. There are fantastic tax breaks when you own real estate, right? You can depreciate it, you can write off your expenses. And then when you go to sell real estate, there are fantastic tax breaks that allow you to get out of paying your tax bill on the sale as well. Every person in this room should know these two tax laws because they are going to impact almost every real estate transaction you work on. All right. The two tax laws that you need to know are Section 121 of the Internal Revenue Code and Section 1031 of the Internal Revenue Code. All right. Section 121, most of you are familiar with. Section 121 is the basic homeowner's exemption. This says that if you sell your primary residence, you can avoid paying taxes on the first $250,000 of gain if you're single, and the first $500,000 of gain if you are married. Okay, this is only for your home, though. All right, it only applies to a home that you live in. And you have to have lived in the home for 2 out of the last 5 years in order to qualify. That's not what we're talking about today, though, because my clients are not selling their homes. My clients are selling investment properties. And the tax break available for investment properties is Section 1031. All right? Section 1031 is a little bit different. It is not tax avoidance. With Section 1031, what we're looking at is tax deferral. All right? What is the difference between avoidance and deferral? Well, avoidance is fantastic. Avoidance, you do not have to pay. With tax deferral, you do not have to pay today. You're not off the hook, right? But you don't have to pay today. You're kicking the can down the road. Now, with the 1031 exchange, when do you pay your taxes? Well, you don't pay as long as you continue to own the real estate, but as soon as you stop exchanging and you cash out, the tax bill is due. And let me give you an example though. Okay. A lot of my clients will start off small. They'll sell a 2-unit building and they'll use the 1031 exchange to go out and exchange into something bigger, maybe a 6-unit building. And then maybe 10 years later, we'll sell that building and go out and do an exchange into something even larger, maybe a 20-unit apartment building. Now, the power of the 1031 exchange, ladies and gentlemen, is they've never paid their taxes. They've used money that would have gone to the government to get into these bigger and better apartment buildings. The problem is, though, my client now wants to sell the 20-unit building. So if she does, what happens is she pays the taxes on the gain from the 20-unit building, but also all of the previous transactions. So what she has done is if she cashes out, is she's built a big snowball of taxes that kept getting bigger and bigger with each successful real estate transaction. And if she cashes out, she's got to pay the tax bill. Now, how do you avoid paying that tax bill? You don't cash out. When you are a real estate exchanger, one of the strategies for not paying your taxes is what we call the 3 Ds of investing. You defer, and then you die. When you do the 3 Ds of investing, you pass away owning your real estate. You don't cash out. You own the real estate until you pass away, and that tax liability dies with you. The great thing about real estate is your kids are going to inherit the properties when you die, and guess what? The basis in the property will step up to fair market value when you pass away, and your children can sell that 20-unit apartment building and pay absolutely nothing in taxes. The tax bill died with you. Your kids got to inherit the property. And remember when we talked about basis and calculating your tax bill? Well, if the basis steps up to fair market value, there is no gain. So, people who are doing 1031 exchanges, if they plan accordingly and they understand the implications of how the tax code works, they can invest for 20, 30, 40 years, their entire life, and never pay a dime in capital gains taxes. This is fantastic. It is a phenomenal wealth building tool, and it is a great way to pass on wealth to future generations as well. All right, so the 1031 exchange is very, very powerful. Now, before we leave this slide, ladies and gentlemen, I do want to mention one other thing. You've got 2 pieces of tax law that you need to understand. The 1031 exchange, but also the homeowner's exemption. Remember, this one's for your primary residence, and this one is for your investment property. But there are occasions where you can use both of these tax laws together. Let me give you a really easy example. Imagine if you own a 2-unit building. All right, so take a look at your computer screen. I'm going to draw a 2-unit building here. You live in the top unit and you rent out the bottom. Well, when this building is sold, you can do a 1031 exchange on the value of the rental component, but you can also take your homeowner's exemption on the value of the unit that you live in. So if it's an equal split, 50% is rented and 50% is lived in. If this building is sold for $2 million, you've got a $1 million primary residence sale and a $1 million investment property sale. You're going to take the homeowner's exemption on your primary residence, and you can do a $1 million 1031 exchange. You can walk away from the sale of this property paying absolutely nothing to the tax man. These tax laws are very important because they save clients hundreds of thousands of dollars. Now, it doesn't have to be a 2-unit building. You could have a piece of land, a giant farm with 60 acres, and you can have a little house on that farm. If you sell the property for $5 million, you can take your homeowner's exemption on the piece or of the property that you live in, and then you can do a 1031 exchange on the value of the 60 acres. You can walk away from the sale of this farm and pay nothing to the tax authorities. All right? So understanding how these tax laws work and spotting opportunities for your clients to use these together on the sale of one property are going to be fantastic opportunities for you to demonstrate value to your clients and save your clients hundreds of thousands of dollars in tax liability. I see it happen all the time. All right. So 2 pieces of tax law that you need to know: the homeowner's exemption for your primary residence, the 1031 exchange for your investment property. And keep in mind, sometimes you can use both of them together. Now, if you're going to do a 1031 exchange, you have to understand the rules. And this is our advanced 1031 exchange class, so we're not going to spend a lot of time on the basic rules. What I want to spend a lot of time on is the advanced concepts of how to use these rules. All right, but let's go over these rules real quick. Number 1, whenever you do a 1031 exchange, the properties involved in an exchange have to qualify. How does a property qualify for 1031 exchange? Well, it has to be used for business or investment purposes. Properties involved in an exchange have to be like kind. What does that mean? Well, a lot of people get confused by this like kind requirement. Some people think that, geez, if I sell a 2-unit, I have to buy a 2-unit building. That is not the case, all right? All real estate is like kind. If you sell farmland, you can exchange into a rental home. If you sell a rental home, you can exchange into an apartment building. If you sell an apartment building, you can buy an office building. It does not matter. You can go from California to Ohio, from Ohio to New York, anywhere in the country. You have a lot of flexibility. Couple things to note, however. You cannot do a 1031 exchange outside of the United States. If you sell in the United States, you have to buy in the United States. But you can go to any state. Like I said, California to Ohio, Ohio to New York, does not matter. One other consideration. Inventory is specifically prohibited from being exchanged. The tax law states that you cannot do a 1031 exchange on inventory. Now, for most real estate people, they would consider inventory not even applicable, right? How is real estate inventory? Well, real estate is inventory if you are buying it with a specific intent to sell. And guess what? That is the definition of a quick flip. So flippers, people who buy property, fix it up, and sell it, cannot do 1031 exchanges because their product is considered inventory and it is not permitted to be exchanged. So if you are a flipper, ladies and gentlemen, you cannot do a 1031 exchange. The rule of thumb in the industry is that you need to rent your property out for at least 1, but preferably 2 years in order to have the property eligible for 1031 exchange treatment. So, season your property as an investment or business for at least 1 to 2 years, and then you are eligible to do the 1031 exchange. Make sense? Now, I had a question come up this morning from a client of mine. He said, well, geez, Leonard, I'm going to buy a property in Incline Village near Lake Tahoe. And in a 1031 exchange, he wanted to know if he could use the property, right? It's a property at Lake Tahoe. Of course he wants to use it. And the answer to that is yes, you can personally use the property, but there are use limitations. The government says that you can personally use your 1031 exchange property 14 days per year or 10% of the amount of time it was rented. So for those of you who have property in Napa or in Mammoth or in any great vacation area, if you personally use that property too much, it is not going to be eligible for 1031 exchange. Again, how much is too much? Well, the government says you get to use the property 14 days or 10% of the amount of time it was rented. If your personal use exceeds these standards, you are now ineligible from exchanging that property. So you got to be careful. Now, Larry wants to know, if I rent the property out as an Airbnb or VRBO, does that count? Absolutely. You can use the property you bought in an exchange as an Airbnb. You need to have it rented out. And again, you need to limit your personal use. As long as you do that, you're going to be fine. Now, Leilani wants to know, well, geez, what happens if I have a property that I'm flipping, but it takes me 2 years to flip it? Well, guess what? You cannot exchange that. It's still a flip. If you're buying the property with a specific intent to flip it, it just takes you a really long time to flip it, it's still a flip. All right? What I want to see on your properties that are exchanges is rental income. And I want you to season your tenants in the property for at least 1, but preferably 2 years. Okay? If you get to 2 years of rental activity on the property and you get audited, you're going to be fine. If you only have 1 year of rental activity and you get audited, you might have the exchange disqualified. Now, there is gray area because the government does not tell us exactly how many days, weeks, months, or years a property has to be rented. But I know, based on being in the business so long and dealing with clients who have been audited, if you've only got 1 year of rental activity, you might get the exchange disqualified. If you've got 2, you're good to go. Now, Leilani's got another question. She says, how does somebody know that the owner used a property for more than 14 days? Great question, Leilani. They don't. Unless there are property management logs that are tracking how many days you're personally using the property, it's going to be really hard for the IRS to know that you were in the property for 15 days instead of the required 14. So is there some room to fudge? Probably. Am I recommending it? No. All right. But it's really hard for the government to know that, hey, you exceeded the 14 days by 1. No, they're probably not going to know. All right. So rule number 1, when you do your exchanges, make sure your property's qualified. If you have any questions on whether or not your clients or your property is going to qualify, this is what you do. You pick up the phone and you call me and you explain the fact pattern and the use of the property, and I will let you know if that client should do an exchange or if it's going to be too risky. All right? So use me as a resource. Everybody's got unique situations, so pick up the phone and we'll go over your specific situation. Rule number 2. When you do a 1031 exchange, if you do not want to pay taxes, I need you to do 2 things. Number 1, reinvest all of your sale proceeds. And number 2, make sure that you purchase property equal or greater in value. And again, whenever I talk about value for 1031 exchange purposes, I'm talking about your net sale price, okay? So we're going to sell a property for $1.1 million. We're going to pay $100,000 in commissions and closing costs. Our net sales price is $1 million. If I don't want to pay taxes, how much real estate do I need to buy in my 1031 exchange? That's right, $1 million or more worth of real estate. When I close escrow on my sale property, I'm going to get $500,000 of cash. That needs to be the down payment on my $1 million property. So, ladies and gentlemen, if you had a loan on the sale property, you're going to probably need to get a loan to buy your new property as well. You do not have to. If you want to contribute additional cash, you can do that. So if you have $500,000 sitting in your piggy bank that you want to use instead of getting a bank loan, you can do that. You buy this $1 million property all cash, that's fine. The important thing is if you sold for a net sale price of $1 million and you don't want to pay taxes, you need to use all of your cash as a down payment and buy property equal or greater in value. If you do that, you defer 100% of your taxes. Now, what happens if you don't do that? What happens if you sell for $1 million but you buy for $950,000? Well, ladies and gentlemen, that's not the end of the world. You simply pay taxes on the difference when you trade down. All right, so $50,000 is going to be taxable because you traded down in value by $50,000. Whenever you go down in value, the trade down difference is taxed. Not the end of the world, but you will pay some taxes. Now, I've got a question. Larry says, do the funds invested to prepare a property for sale affect the sale price? Absolutely not, right? So Larry is going to put $100,000 into fixing this property up before he sells it. That doesn't matter for his 1031 exchange. Now, he might be able to sell the property for 1.2 because he fixed it up. So, I mean, that's helpful. But for 1031 exchange purposes, I don't care how much you put into the property. What I care about is what your property ultimately sells for, because that's the value that you need to replace. Now, again, the improvements that you do to your property will increase your basis, as I described when we calculated our basis 5 or 6 slides ago. But basis is only important if you pay taxes. If you're not paying taxes because you're doing a 1031 exchange, I don't care what your basis is. But very good question, Larry. Okay. So rule number 2 is reinvest all of your cash and purchase property equal or greater in value. And before I move on from this slide, I want you guys to know that you can buy multiple replacement properties to complete your exchange. So if you sold one property and you want to buy 2, that's fine. As long as all of the properties you buy are equal or greater to what you sold, you defer all of your taxes. Some clients will want to buy sell 3 and buy 1. That's fine as well. As long as these two rules are met, you're going to defer all your tax bill. So very, very important. If your clients are selling, again, for $1 million, you know that whatever they do and however many properties they buy, they need to own at least $1 million worth of real estate to defer 100% of their taxes. Rule number 3. When you do your 1031 exchange, you've got a time frame. And that time frame is very strict. You've got 180 days to complete the entire process, and you have 45 days to identify what you're thinking about buying. Your time frame starts the day you close escrow on the sale of your property. As I mentioned, you've got 180 days total to complete the purchase of your replacement properties, and you have to identify what you're thinking about buying on day 45. Very, very important that you know your time frames. You go out and start looking for property right away, because those 45 days are going to go very quick. And on midnight of day 45, you need to submit your identification letter on midnight or sooner, right? And your identification letter is going to state in writing the properties that you're thinking about buying. So this is what an identification letter looks like. You're going to fill it out with your name, you're going to sign it, and you're going to list out the properties that you're thinking about buying. And there's 2 ways to fill out the list. All right? The most common way to fill out the identification list is to use the 3 property rule. The 3 property rule says you can identify 1, 2, or 3 properties. Really that simple, right? You get to identify 3 properties on day 45 if you use the 3 property rule. Now you might be thinking, well, geez, that's a bummer. I wanted to list more than that. Well, you can, all right? If you use the 200% rule, which is our other option for our identification letter, the 200% rule allows you to list as many properties on your ID letter as you want. There's no limit on the number. The problem with this rule is that there is a limit on the value of the real estate. And the value limit is 200% of what you sold. So if you sold $1 million worth of real estate, using the 200% rule, you can identify $2 million worth of replacement property. In my example, that's 6 pieces of property, but if you go out to Texas, maybe it's 10 pieces of real estate. The number of properties is not important. What we look at here is the value of all the real estate. All right. Now, again, we're going to help you identify. We're going to make sure that you understand the rules, but it's very important to have some of these concepts in your mind before you get involved in an exchange, because some people get into an exchange blind and they think that they can go out and list 15 or 20 properties of of unlimited value. And ladies and gentlemen, you just can't do that. So it's very, very important to understand the basics. And then when we understand the basics, we can really get into some really interesting and creative ways to structure our 1031 exchange. All right. So what I want to share with you now is a couple advanced strategies that really kind of use the concepts to maximize or minimize the minimize the tax liability that clients will have. But before we do that, I want to answer some of your questions, okay? Eva wants to know, will you send us a copy of this presentation? And the answer is yes. Tony says, are the rules the same for the reverse exchange? And yes, they are, okay? Stephanie wants to know, please repeat what the 3 Ds stand for. Ladies and gentlemen, the 3 Ds of investing: defer, defer, and then die. All right. And what that really means is you just never sell. You own the property until you pass away. And this is a great strategy because it allows your kids to inherit the real estate at a stepped up basis. And a step up basis means the tax liability that you've been deferring throughout your ownership goes away. All right, Mark has a question. He says, are primary residences below $500,000 of gain exempt from state and local taxes? No. Right? If you have less than $500,000 of gain, you have your, well, I don't know if I understand the question. So local taxes, state taxes, transfer taxes, all those are paid. Capital gains taxes are exempt. So maybe you can clarify that question. Leilani asks, with a DST, can we park the funds there until we find another property? And the answer to that is no. A DST is a vehicle that allows you to own a slice of a very large building, but they are not parking mechanisms. When you get into a DST, you are in it for usually 5 to 7 years. A DST is not a temporary investment. Tony says, can you please share if improvements like cleaning hazardous material off of the property counts if you fall short of an exchange? All right, ladies and gentlemen, let's talk about closing costs. All right. If I am in contract to sell my property for $1.1 million, I can deduct all non-recurring expenses. Now that might be $60,000 for my commission. Let's say it's $10,000 for my escrow and title. And then we've got another $5,000 in transfer tax. Okay. Those are the most common items. If you are paying something to conduct a sale, it can be deducted. However, if you are improving your property, it is going to be classified as a capital improvement and it will increase your basis. If you are doing hazardous material, that is probably going to be written off as an expense. Okay? So all of these items that you pay, you're going to add them up and you're going to classify them either as a selling cost or as an expense or a capital improvement. And your CPA is going to make those determinations if it is unclear. All right? Tony's got another question. Okay, so I don't know, or I'm going to skip that, Tony. Now, Mark's got a question. Is the value of destination property the actual price paid or listing price? Okay, good question. So we're looking at when we're identifying our properties using the 200% rule. Tony wants to know, we've got the 200% rule back here. Mark wants to know, well, geez, this property was listed for $150,000. Do I use that for my value? That's a great question. You get to use whatever number you want, but it has to be reasonable. So if the listing price is $150,000, but you're going to offer $130,000, for your identification letter, you're going to use $130,000. Now, can you use $15,000? No, absolutely not. It's got to be reasonable. Okay, so any reasonable, defendable assessment of value for this property is what you're going to use. If they're asking $150,000 and you put $130,000 because that's your offer, that's what you can use. Absolutely. Okay. So Mark says, sorry, I meant, is the sale proceeds from a primary residence exempt from state and capital gains tax if the gain is below $500,000? Yes, absolutely. And then finally, before we move on, Michael says, under the defer, and die, can someone other than the children receive the step up in basis? Absolutely, Michael. You can nominate me to inherit your property, and I will get a step up in basis. So please nominate me as your heir. It would be my privilege to inherit all of your real estate. Okay, ladies and gentlemen, check out this slide. This is an awesome slide. How many of you have rental properties? Most of you, right? How many of you want to exchange them? Well, there might be some of you that might not want to exchange, right? Maybe you're done with real estate and you're thinking, well, geez, I'd love to get out of this real estate without doing an exchange, but I don't want to pay taxes. So how about if I move into the property? You can do that. And ladies and gentlemen, when you move into the property, if you live there long enough and you sell it, guess what? You can take your homeowner's exemption, section 121. You can convert your rental into a primary and then take the homeowner's exemption. That's a great idea. The problem with this is that so many people were doing it that the government said, whoa, 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 we don't want you to do that anymore because you guys aren't paying your taxes. And then we had some pushback, and the government said, okay, you can still move into your primary residence and take your homeowner's exemption, but we're going to prorate the gain out between the years that you live there and the years that the property was rented, and only let you take the gain that is allocated to your primary residence use. So let me give you an example. You're going to have to pay attention to your computer screen because this is a little bit tricky. You've got 2 years of rental and 2 years of primary for a total of 4 years of ownership. So 50% of your gain is going to be allocated to your rental time. The other 50% of your gain is going to be allocated to your primary residence. When you sell the property, only the gain allocated to the primary residence time is sheltered under the homeowner's exemption. The rest of the gain is taxable. Does that make sense? So moving into your rental is a good idea to minimize your tax liability, but it will not eliminate all of your tax liability because the gain associated with the rental period is automatically taxed. Does that make sense? So, can I move into my rental? Absolutely. Can I take my homeowner's exemption? Absolutely, on a portion of the gain. Very important. Now, let's talk about the opposite. Ladies and gentlemen, this is my favorite strategy in all of 1031 exchange. Okay? This is a phenomenal strategy if you have a client who bought a very nice home a long time ago and has lived in it forever. Right? So imagine if you bought a property way back when for $100,000. The property is now worth $1 million. How much gain do you have? Well, you have $900,000 of gain. And if this is your home and you're married, $500,000 of that gain is tax-free. The problem is all of the excess gain of $400,000 is taxable. And if you sell the property as your primary residence, you're going to pay $100,000 in taxes. So what do? Well, if you sell the property as your primary, you pay $100,000 in taxes. But if you're smart and you understand how the tax laws work, you move out of the property and you convert the property to a rental. You establish that property as a rental for 2 years so that when you sell it, you will qualify for what? That's right, 1031 exchange. Now, the property is in escrow. It is clearly evident that it was a rental for 2 years prior to the sale, so you absolutely get to do a 1031 exchange. But guess what, ladies and gentlemen? You have also lived in the property for 2 out of the past 5 years, so you also are eligible for your homeowner's exemption. Section 121 of the Internal Revenue Code. Ladies and gentlemen, you have a situation where the property you are selling is eligible for both 1031 exchange and the homeowner's exemption. If you are eligible for both tax breaks, which one do you take? You take them both. That's right. You're going to sell your property for $1 million. Because you lived in it for 2 of the past 5 years and you are married, the first $500,000 is going to come out and into your pocket tax-free. The remaining value is going to be a 1031, and as long as you go out and exchange the remaining value, you pay absolutely nothing in taxes. So you would have paid $100,000 in taxes had you sold it as your primary. If you rent it out and then do an exchange, you can convert that $100,000 tax bill to absolutely nothing. And ladies and gentlemen, I have worked with clients who have done this not on $1 million properties, but on $5 million properties. They have saved themselves $1 million in taxes. It's ridiculous. It's a phenomenal rule. It's a phenomenal strategy for people who have owned property as a primary residence for a very long time and have gains in excess of their homeowner's exemption amount. Don't pay the tax bill, just move out. Rent the property out for 2 years, do a 1031 exchange, and claim the homeowner's exemption. Very, very, very good stuff here, ladies and gentlemen. All right, we're running out of time. I'm going to have to shut the show down because I'm working from home, and I think most of you are, and I've got a 5-year-old and an 8-year-old who are having lunch with their dad today. So very important meeting right at 12 o'clock, and I know you guys got to run too. But before we move to shut down the presentation, I do want to talk about the reverse exchange. Reverse exchanges allow you to do your exchange in reverse. So instead of selling your property and then buying, you're going to do the opposite, right? You're going to buy first and then sell, all right? So you purchase your replacement property first, and then you have 180 days to get your property sold. Now, why are you going to do this? Well, you're going to do this because you found a great property today and you want to close on it, right? Well, doing a reverse exchange is trickier than just going out and buying the new property, okay? Because you cannot own the new property and the old property at the same time. So to facilitate a reverse exchange, my company is going to buy this property on your behalf. That's right, ladies and gentlemen. We become the straw buyer of this new property. And you only get to own it after you sell your old property. So what we're doing is a shell game, right? I become the straw buyer of this property. My company owns it, but we lease it back to you. Okay, so you get to use the property under a triple net lease. So you get all the burdens and benefits of the property, but my company is on title. And we remain on title to this property until you get your property over here sold. Once this property sells, you can become the owner of the replacement property. Guess what? These deals are expensive to do. Lenders do not like to loan on them. And every time there is a transfer of ownership, there is a transfer tax. So you've got to factor in with these reverse exchanges that they're difficult to finance, that my fee is higher. So we charge $6,500 to do a reverse exchange. And every time there's a transfer, you've got to pay a transfer tax. So there's 2 transfer taxes minimum on a reverse exchange. All right. So I tell people, hey, reverse exchanges are possible, but I like to ask if you can avoid the reverse exchange to try to do so. All right. So there's a few things here. I think we talked about a lot of these things kind of throughout the course of the presentation. But what I want to do now, because we're well over our time frame here, is wrap up. But I do have some questions here. I'm going to tell my kids to hold off on the peanut butter and jelly sandwich that I was going to make them while I answer some of these questions. All right. So we're going to hang out for 5 or 10 more minutes and answer some of these questions. Tony says, "Hey Leonard, sorry for the confusion. My question is, if I buy a property for $350 and the relinquished sells for $400, and I've used up the commission." Okay, Tony, we're gonna need to talk offline here. Just give me a call afterwards. All right. Sorry, I'm just reading some of these. Is there going to be a webinar replay? Absolutely. You're going to get a copy of the presentation, and we post all of our presentations to YouTube as well. We'll send you the YouTube channel. Larry wants to know, can I do a 1031 exchange just on the taxable portion? No. Okay. If you bought a property for $100,000 and you're selling it for $500,000, you have $400,000 that is gain, that is taxed. But when you do an exchange, you have to buy a property for how much? $500,000, right? In order to defer all your taxes. So you don't just reinvest your profit. You have to reinvest everything. So I have a question here about, when do you set up your 1031 exchange account? Your 1031 exchange account needs to be set up before you close escrow. So if your close of escrow is tomorrow, you need to set up your exchange account today. But most people, when they go into escrow, they have a 30-day escrow, and you can set up your exchange account anytime during that period. Just do not call me after you closed escrow. All right, a couple other questions, then we're going to wrap up. How long can you own the reverse property until I sell? Great question, Leilana. I can only own the property for 180 days. Okay, that's how long you have to get your property sold. If you cannot sell your property within 180 days, you're going to fail the reverse, and now you own 2 pieces of property. There's no taxes because, Leilani, you didn't sell anything. All we did was we bought a new property for you. You tried to sell yours and you couldn't. So now I'm going to transfer the new one to you, and now you own 2 pieces of real estate. Stephanie says, when I do my sale of a primary residence / rental, can the other portion of primary gain be reinvested in a 1031? Yeah. You can throw all of your money from your primary residence / rental into a 1031 exchange. Okay, I'm trying to get all these questions. So some of them are tough to understand because I think you asked some of these questions on a particular slide. Probably made sense when you typed it in, but now I'm having trouble figuring out what you guys are meaning. So if I don't get to your question here, just shoot me an email and I'll make sure that I answer your question. I've got one more question here. Are the 3 properties identified on my letter sent to Asset Exchange Company or the IRS? They are sent to Asset Exchange Company, and we are very often subpoenaed by the IRS to provide that identification letter in an audit. So the first thing that the IRS does when they audit you is they send you a letter, and then they send us a letter asking for all of your information. All right, ladies and gentlemen, I do need to wrap up here. My son is knocking on the door. He's got my peanut butter and jelly sandwich waiting for me. So if you have any other questions, and I see a few people here, you have questions on my computer screen, please email me your question. My contact information is on the board. You can call me as well, but call me at 1 o'clock so I have time to have lunch with my son. Everybody have a fantastic rest of your day. Enjoy your time with your kids if you've got them. And we'll be back doing these presentations in person real soon. Thank you all very much, and I look forward to doing business with all of you very soon. Take care, everyone, and shoot me an email if I did not get a chance to answer your question. Take care.